While some mini misadventures can bring laughter to your life, nobody knows when those misadventures may turn into a mishap. It thus becomes crucial that we plan well for our family's future in case something unfortunate happens. By now you might have guessed it right. I'm talking about buying adequate life insurance. Ramesh, a smart working professional, decides to do the right thing, buy life insurance to ensure that his family remains financially secured even after him, just in case. But the life insurance jargons muddled him. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. We have two other channels, ET Money Hindi, where you can watch all these videos in Hindi, and if you're looking for analytical and slightly advanced topics on investing, you may go and check out our channel ET Money. In today's video, we are going to take you through Ramesh's complete life insurance buying cycle and decode the commonly used jargon that either restrict people like him from buying life insurance or they end up being a victim of mis-selling by the agents. Once you understand these terms, it will be simpler for you to pick the best life insurance and also avoid being tricked into getting the wrong one. Ramesh comes across the most common types of life insurance: term insurance, endowment plans, money-back plans, unit-linked insurance plans. Now, a term insurance is the plain life insurance policy where if the policyholder dies, the family gets the pre-decided amount from the life insurer. If the policyholder survives the policy term, nothing is paid. Whereas endowment, money-back and ULIPs are insurance cum investment plans, which means in all these plans, one part of the premium goes to buy life insurance for you and the remaining is invested. Now, ULIPs invest in stocks and debt market and their returns depend on the performance of these markets. But endowment plans offer benefits and bonuses which may or may not be guaranteed by the life insurer. The exact death benefit in these policies is not known pre-hand and it depends on the performance of the investments. Now, impressed by the simplicity of the term plans, Ramesh decides to go with it. He did some math and figured out that a sum of 1 crore would be enough to take care of his liabilities and his important goals in case something happens to him. Now, this amount of 1 crore is called the sum assured. So, sum assured is the amount of money the insurance policy guarantees to pay out to the policyholder or the nominee in the event of a covered loss, usually the death or disability of the policyholder. Next, Ramesh needs to pick the policy term. Now, the policy term is the time period for how long he wants to have the insurance policy. Ramesh is 30 years old and he wants to work till 60 years of age. So, he wants to opt for a 30-year policy term. Now, here you must ensure that you select a policy term long enough till you are financially supporting your loved ones. Then, when Ramesh was getting the life insurance from ET Money, he found something interesting. It's called the limited pay option. It lets you pay premiums for fewer years, but you are covered for the whole policy term. However, these premiums are often higher than the regular payments. Ramesh chose this because he liked the idea of paying off the premiums during his peak earning years. Now let's take a look at the benefits of his term plan. Death benefit. It is the common term that you will come across frequently. It is the amount paid to the nominees if the policyholder passes away during the policy term. With a term insurance policy, this amount is same as the sum assured. For other types of policies, the death benefit may include bonuses and additions. Next, his policy also offers some add-on benefits called riders. Riders are optional and come at an extra cost. Some common ones are waiver of premium, where if the policyholder becomes disabled, his future premiums are waived off, but the policy continues. Then there is critical illness benefit, where if the policyholder is diagnosed with some listed illnesses, he will receive a part or complete sum assured as the policy specifies. Next is accidental death benefit. Now, an accidental death benefit covers fatal accidents, wrongful death, homicides, airplane crashes, falls and fire-related injuries, where if death occurs due to an accident, sum assured plus an extra amount is paid to the family. Out of these common riders, Ramesh decides to opt for waiver of premium and critical illness riders. Now, as Ramesh delved into the details, he found out about exclusions. These are things not covered by his policy. So, if something happens from these exclusions, the insurance would not pay, like suicide in the first year. Each policy can have different exclusions and you must give time to understand them before buying any insurance policy. Let's move to the cost part. Ramesh has to pay an annual fees of 11,500 rupees to buy the 1 crore life insurance policy for 30 years with added riders of his choice. Now, the fee that you pay for the insurance policy is called premium. It can be one time, monthly, quarterly, half yearly, or yearly depending on what you choose. So, Ramesh will have to pay this premium every year. If he fails to do so, his term insurance policy will lapse. However, insurance companies give a few extra days to the policyholder when he or she can pay the premium after the due date is over to ensure that the policy does not lapse. Now, these few extra days are what is called as grace period. Also, after purchase of the policy, Ramesh gets a 15-day window to review the policy. This is called the free look period. If the policyholder is not satisfied with the policy, he or she can terminate it and get the premium refunded. Now, Ramesh decided to go for the life insurance not just for his own peace of mind but to secure his family's future. So, it is important to ensure that the money reaches the right people in case of mishap. He could do that by selecting the nominee wisely. A nominee is the person chosen by the policyholder to get the insurance money when the policyholder passes away. Usually, it's a family member. You can choose to have multiple nominees. We hope it helps you with your insurance decision, making things simpler. But don't worry, as if you still want some help, you can go to the ET Money app, book a free consultation with an insurance expert. The best thing here is that you will get assistance not only at the time of buying the insurance, but also, God forbid, but if there is a need to make any claim. If you liked this video, please remember to give it a thumbs up and share it with your friends and those who care about you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.